presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-873-7618.
Let's go to our man Al in Homosassa. What's going on, brother?
Isn't it wonderful? I went ahead and invested in your Tiger dollars, and I went ahead and got the gold report for a year, and also your morning your call letter and stuff like that. And I got over a 50% return in one day, not counting everything else. But I just want to thank you. Tom's not perfect, but he tells you how to put your stops in, and he keeps your losses small. You can take your small losses, but then all of a sudden you'll be like Dave Root, and you'll hit a home run. I mean, a big home run.
Yeah.
And put the money in your pocket.
Okay, brother. You're awesome, man. Thank you.
Now, Tom O'Brien.
What's going on, everyone? This is Jacob Shoup filling in for Tom O'Brien. Of course, this is the Tom O'Brien Show. We are going to be joined by Tim Ord of the Ord Oracle today, so looking forward to that in the second segment. Won't take as long as we need to get through all of that. Let's take a look right now at where we're at. Well, it was some pretty okay data against the idea of a recession, so we're up a little bit right now in the E-mini, up about 1.66%. Pretty nice, just upward trajectory throughout the whole day. Same with the SPY. Russell up as well with that. People still buying, basically, right? NQ's of about 2.47%. Again, same kind of thing across the board. And the Dow Jones pretty securely above that $40,000 line right there. Gold contract dipped a little bit, but we're back up at 2,498, which is pretty solid. You had it earlier this morning. Quite a major, sell-off down to the, 2469 area roughly, and then we're kind of recovering right now. I think we were trading around a high maybe a month ago, 25.16 if I remember correctly. Silver up about 4.16%, really doing quite well today, a percentage basis there. And then copper contract up 4.14. Crude oil still running pretty high as well today, 130, trading at 77.97. Still, I think, pretty low overall. You have some ideas about, travel demand being down. We are producing a ton of oil right now. Some ways to kind of bolster ourselves against anything that happens internationally. Then also, it keeps stuff down for inflation as well. Tesla roaring right now. I mean, all these EV guys are roaring currently. You have Lucid up 2.23% today. I think Rivian was doing pretty all right as well, up 3.5%. Yeah, pretty good stuff going on. Interesting, you had this whole idea is like, hey, is inflation still persistent? And then you get, that really bad jobs number, and the whole market's like, oh my God, are we going to have, a recession? And then that sells off. And now it's like, oh, no, that was just a glitch. And so we're right back up, moving. Now, I still think over, multi-month period, inflation definitely is cooling. Because one of the things, someone could think would be, well, hey, I mean, you had this massive sell-off, right? And it seems like, this is outside of or rather, let's see, the unemployment numbers are below analyst expectations. Are we right back in an environment, especially with retail spending as well, are we right back in an environment where we need to worry about inflation? And still you're seeing cooling overall with that. So let's talk about the job numbers a little bit. The jobless claims dropped 7,000 to 227,000 last week. The 4-week average of claims, which smooths out week to week ups and downs, fell 4,500 to 236,500. In the week that ended August 3rd, 1.86 million Americans were collecting jobless benefits. That's down 7,000 from the week before. I think as well with some stuff, regarding these job numbers, being lower, and that might be indicating, potential recession. I think something that's important to know as well is not so much of these jobless claims are from people getting laid off, but maybe more people entering the market as well, and there's just not new positions opening up. Now, of course, we have seen job cuts in some areas, but I would argue those are companies that had a lot of excess spending, and their capital was finally shoring up, and this is over the past 2 years or whatever, and that's kind of to be expected, especially with the larger tech companies as well. The claims have fallen 2 straight weeks, dispelling worries that the job market was deteriorating rapidly rather than just slowing. Let's see. Yeah, so lately higher rates have finally seemed to be taking a toll. Employers added just 114,000 jobs in July, and that's well below the July through June monthly average of 218,000. The employment rate rose for the 4th straight month in July, though it remains low at 4.3%. Monthly job openings have fallen steadily, really what I think is happening with this as well, since peaking at a record of 12.2 million in March 2022. And then, of course, you had retail pretty strong as well, up 1% in July versus, I think, analyst estimates were like 0.4 or something like that. I mean, that's a really strong market still, Bloomberg also has an article saying that the quant funds are ready to put a bunch of cash into the stock market. It's weird. I was asking that question yesterday, like how much does a single rate, 25 basis points cut generate economically? And I think you're seeing a lot of pent-up demand in housing. I think you're still seeing a strong consumer. We were talking a little bit about Tapestry, which, give me a second to get the, they have like the Coach brand and everything like that. Now, they declined a little bit, right? Let's take a look. Yeah, these guys have luxury brands, right? They declined a little bit in Q2, earnings-wise, but they're still like, hey, I mean, things are good. We're just kind of flat right now. We talk about that a little bit. The Coach hit $5.1 billion in annual sales. Gross margins for the year expanded 250 basis points to 73.3% of sales. Yeah, I mean, there's still like somewhat resilience in the market, right? Which is interesting to see how that's going to play out, kind of. Now, we could talk about as well Deere, and this is what I've been saying about how these high interest rates can like disproportionately affect certain people, right? So John Deere had really bad earnings, and that's because the farmers get so messed up by high interest rates. Let me try to pull this up. But I guess they say it's going to be fine. So, I mean, Deere's up right now anyway. But you've had this, like, pretty strong, like, I mean, yeah, they're up 7.41 on forward guidance. But you're seeing the effects of these high interest rates starting to take toll, especially in the recent past on them. And, yeah, I don't know. I do think we are going to get this interest rate cut, but I do somewhat fear that since we're still seeing some relative strength, that you could run into issues going forward. That I mean, we might see a small uptick in inflation and getting off, away from that 2% target. We're really at 2.9 on the CPI year over year. So I don't know. Folks, stay right there. We'll be right back with Tim Ord of the Ord Oracle.
If you spend any time online researching trading techniques on how to begin your trading journey, you've no doubt come across many folks who push Forex trading as a way to make big money quickly. Unfortunately, there are equally as many stories of these so-called Forex professionals just looking to make a quick buck off aspiring traders without actually teaching the ins and outs of the Forex market. This is what sets Teddy Keckstack's The Tiger Forex Report off the riffraff. Every Monday, former Chicago Mercantile Exchange member and author Teddy Keckstad releases his Tiger Forex Report newsletter, where he dives into the complex world of Forex and takes time to actually teach you his methods that have made him so successful in the fast-paced and rewarding world of Forex trading. Furthermore, all subscribers receive access to archived live streams of Teddy's, where he provides university-level education to help you in Forex trading. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Forex awaits.
The stock market is a delicate, interconnecting web of commodities, equities, and trader psychology. When one string of the web is pulled, It has a ripple effect across the broader market. This is where opportunity lies. But how are you to gather all of this information into one cohesive model when you're already spending your energy looking for any possible trade opportunities? Luckily, you don't have to worry about that, as Tom O'Brien has brought all important market news to you in one single newsletter, Market Insights. Market Insights provides a daily overview of what's happening in the indexes, bonds, gold, and more. Follow along with Tom daily as he analyzes the components that affect the overall movement of the stock market, giving insight into how each one plays either a bullish or bearish role. Tom also analyzes specific equities that he believes has the potential to make huge returns, and his track record proves his analysis right. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Don't let the market leave you in the dust.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Welcome back, everyone. Still waiting on Tim Ord here. Let's take a look at, if I can get this running, some potential movements. Some potential movements with nuclear going forward. Of course, NNE had a nice pop-up yesterday with the deal with Rwanda that they're doing. And then you have the U.S. Energy Secretary. I'm going to pull up CCJ as well. The U.S. Energy Secretary calls for more nuclear power while celebrating $35 billion Georgia reactor. So this is like hyper bullish on the long term, I think, for nuclear. No doubt, I think this is going to be a huge part of our energy portfolio. So speaking in Waynesboro, Georgia, and 3 other utilities last month put a second new nuclear reactor into commercial operation. Granholm said that the United States needs 98 more reactors with a capacity of units 3 and 4 at Plant Vogtle to produce electricity while reducing climate change and carbon emissions. Each of the 2 new reactors can power 500,000 homes. The federal government says it is easing the risks of nuclear construction. But the almost $17 billion in cost overruns at Plant Vogtle near Augusta remain sobering for other utilities. Anyways, I think you're going to get a big injection with this as well. Let's see here. The new reactors are currently projected to cost Georgia Power and 3 other owners $31 billion. Yeah, but I really do think the point is that like this is going to expand so much more quickly as time goes on. You're also seeing a convergence too, and I've been noticing it, I think, in this current election cycle, that there's a convergence of a lot of similar beliefs among the 2 parties, and I think it's this move towards this kind of like populist idea. I mean, you're even now having Trump talk about potential with EVs by sitting down with Elon Musk and doing all this kind of stuff. He's kind of calmed down some conversation against those things, right? And I think nuclear is going to be one of them as well, as these kind of larger cultural shifts we're expecting to happen. So I think this is really neat. See if there's anything else that's of any importance. Kind of more just talking about this reactor in particular. But I would take a serious look again at NNE as well. And then, of course, you have Oklo, which is Sam Altman's guy. Let's see what he's up to today, if anything, on this news. Down a little bit right now, but still, I think those guys can be major players with it. It's a unique kind of approach for everything, but we'll see what happens with that. Some news as well regarding Medicare. I'm going to pull this over here. So Medicare negotiated drug prices for the first time, and here's what it got. This is super interesting. So the White House unveiled the fruits of months of negotiation between the government and pharmaceutical companies. New lower Medicare prices for 10 blockbuster drugs. Discounts range 79% for Januvia to 38% for blood cancer drug Imbruvica. Health and Human Services Secretary Xavier Becerra played up the savings Wednesday evening. So Medicare would have saved $6 billion if these were in effect. Medicare would have saved $6 billion, and beneficiaries would have saved $1.5 billion in out-of-pocket costs, such as copays at the pharmacy counter. This is pretty huge, and this is what I mean. I think this kind of stuff still is going. Now, this is, with some of the current kind of administration going on, but I think this stuff's going to kind of persist, which is a neat kind of thing to see this country shift in such a way. And all these 10 drugs alone cost Medicare $50.5 billion in 2022, or about 20% of the program's gross total drug spending that year. They also cost beneficiaries $3.4 billion in out-of-pocket expenses. So that is pretty solid, even, for all of us who are going to have to do that at some point in the future. Now, folks, let's go over here to the ordoracle.com. That is ord-oracle. Every Tuesday and Thursday, we have Tim Ord of the Ord Oracle come on the Tom O'Brien Show, and he goes through a few charts, mainly talking about the market and sometimes gold as well. Tim, we are happy to have you on again. How are you doing?
Good. Thanks for having me on again.
Absolutely.
So, let's get right to the charts. Actually, we didn't really go over gold last time I was on. So actually, we'll take a look at the bigger picture and work it all the way down to where we are on a short-term basis. And so chart number one, seen this before, but it's just kind of a repeat. But it kind of, refreshes the mind, I guess you might say. But the first chart is a monthly GDX. So you look at the bigger picture, and the bottom window is a GDX up-down volume indicator. And anyhow, we use the Bollinger Band as a trigger. And once it gets above the mid-Bollinger Band, momentum has turned up on the up-down volume, and that's usually a consistent buy signal. Next window up is the monthly advanced decline with the Bollinger Band. And again, the buy signal is when it closes above the mid-Bollinger Band, it's a buy signal. Those indicators were triggered on May 31st. And as you can see, both indicators are still making higher highs. Actually, they're pretty much just making higher highs. It's pretty much gone straight up since end of May, 1st of June. And so that's usually a good signal. A lot of these advanced declines and actually up-down volume, once they start in a trend, they usually continue in that trend. So signals in the past of this type have lasted a minimum of about a year and a half. So the trigger was triggered on May 31st, so you add a year and a half to that, you come out with, November? November of 2025. So let's go with chart two. This looks at the weekly chart, same indicator, but on the weekly chart, same trigger. Once both indicators close above mid-Bollinger Band, which they have, that did it on March 18th. And those signals also last about a year and a half, not longer. Some has lasted up 4 years. But again, momentum's the key. The weekly charts are on a buy signal since March 18th. And they also like a year and a half. Well, a year and a half from March 18th takes in about September of 18th, 2025. So this impulse wave should last a while. So it's good down to a little bit shorter term. This is chart 3.
Perfect.
And the bottom window seems to work the best. And it's the 50-day average of the up-down volume. Advanced decline works not as quite as well. So I take the signals off the up-down volume over. I went back and tested this. And once the up-down volume, for some reason, just works better than advanced decline. But anyhow, the bottom window is the up-down volume percent with the 50-day average. And as long as this indicator stays above zero, we're coming in around plus 11 right now, the uptrend is still intact. When it falls below zero is when usually you get corrections that can last several weeks, if not several months. And all that kind of a green area across the charts are when this indicator was above 0, and it got triggered, looks like about mid-March, and it still remains on a bicycle, even though since mid-March they had kind of several different minor consolidations, but in general, the internals are actually strong. What that anticipates, oops, I hear the music.
Yeah, Tim, stay right there. We also have a question from a viewer when you get back. Folks, stay right there. We'll be right back with Tim Ord of the Ord Oracle in just a moment.
Many trading newsletters attempt to focus on a narrow set of equities or commodities. While this works for some, it oftentimes misses many opportunities that possess huge gain potential. But how is an independent trader supposed to scan the entire market looking for these hidden opportunities? One simple answer: the opening call newsletter. Basil Chapman, developer of the Chapman Wave trading methodology, has been trading the markets for longer than most trading influencers have been alive. And over that time, he has honed his methodology in order to accurately call movements in a wide range of equities, from semiconductors to uranium to key indices and so much more. Basil is old school, taking the time to educate the trader while also giving his insights into key indices, selective stocks, and more. Opening call subscribers also receive access to dozens of educational live streams that can be accessed at any time for your edification. All first-time subscribers receive a 30-day money-back guarantee. So ignore the pop trading influencers and start learning time-tested technical analysis.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
The consistency you're looking for is closer than you think. 1 or 2 adjustments are usually all you need to change your equity curve from red to green and keep it there. Come join Larry Pesavento live to learn what separates the winners from the losers. Join Larry Pesavento on the 2nd and 4th Friday of every month for 3 hours of live trading from 9 a.m. to 12 p.m. Eastern Time, where Larry will show you the market setting up and, most important of all, the state of mind of a winning trader. By watching Larry trade, you'll learn the Fibonacci levels, you'll learn how to apply 8B to C to D trading patterns, you'll learn trade management, pattern recognition, and much more. Join Larry Pesavento Friday, July 12th and Friday, July 26th, 9 a.m. to noon Eastern Time for 3 hours of live trading. For this month only, use promo code LarryJuly24 at checkout to save $50 on your first month's subscription. For all the information and to reserve your spot today, visit the front page of TFNN.com.
This portion of the Tom O'Brien Show is brought to you by Direxion's daily leveraged and inverse ETFs. Whether you're a bull or a bear, you choose the direction. Visit Direxion.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direxion.com. Read carefully. Distributor Foreside Fund Services, LLC.
Welcome back, everyone. This is Jacob Shoup filling in for Tom O'Brien. We are joined by Tim Ord of the Ord Oracle. Tim, before we went to the break, we were on chart 3, but we had a question on the YouTube chat. It was regarding chart 1, the GDX advanced decline. What I'm assuming is asking regarding the price. But if you're seeing a movement above that upper Bollinger Band, does that usually indicate a movement back down near the mid? Or do you see any kind of trend reversal, or could it just stay up in that area, indefinitely and inform basically new range with the Bollinger Band?
So which okay, so we're chart
I'm
one,
assuming he's asking
what indicator, or is he talking about GDX, or is he talking about one of the up-down volume advanced decline indicators?
I'm assuming he's asking price. I'm going to wait for him to say something in the den there.
Well, there's actually the market is momentum's really the powerhouse, I guess you might say. Momentum rules all indicators. I'll put it that way. If the momentum's up, then in general the stock market is going to move higher. If you want to make life easy for you, take a Bollinger Band, put it on the weekly chart and the monthly chart. As long as that stock or index or whatever stays above the mid-Bollinger Band, the trend's up, period. Once it falls below the mid-Bollinger Band, then everything changes. And it also works, this, I guess, continuity also works with advanced decline and also works with up-down volume. So once momentum starts going in a direction, it usually stays in that direction. It's kind of like kinetic energy. It's kind of like physics. So it works the same way. So the market is not random. It just works off of momentum. So if he's talking about the GDX price, which right now is above the mid-Bollinger Band, I favor, if he's talking about that, if the GDX falls below the mid-Bollinger Band, does that create a sell signal? It does weaken the uptrend, but I really key off of the up-down volume advanced decline indicators. As long as those two indicators stay above the mid-Bollinger Band, whether GDX above or below mid-Bollinger Band, it's really the momentum of the advanced decline and how much up volume there is compared to down volume. That's really the force of the market, even though price may fall back because on GDX, it's an index of stocks. It could fall back because of one stock in that index, but as long as momentum of price and price and volume is going up, the index will eventually go back up.
Now, if it moves above in the up-down volume, above the upper Bollinger Band, does that signal that it's kind of losing steam a little bit? Like if you look at it as like a system in that way, or could it indefinitely stay in that period and again just kind of redraw? And that's on the up-down volume.
Up-down volume. Okay. On chart 1, we're looking at the monthly, right?
Yeah.
All right. Yeah. It's up down. As long as that stays above the mid-Bollinger Band, the uptrend's intact.
Okay.
So
perfect.
All right.
Awesome deal.
So we can go back to chart 3?
Yes, I have it up right now.
All right. So anyhow, the 50-day average is kind of a little bit, which is the up-down volume again. I think this indicator is more accurate, I guess you might say, than an advanced decline indicator. But as long as it stays above 0, the short-term trend is up, even though it did pull back here a little bit. There's nothing. And actually, over the last several days, it's been getting stronger as this indicator is going up. But let's look at the short term, which is on page 4. And this is a really good indicator. Again, I'm using up-down volume and advanced decline indicators, and these are cumulative. The top window is the GDX. It's just straight GDX daily. Next window down is the cumulative up-down volume, and below that is advanced decline volume, or advanced decline equities, I guess you might say. So what I want to point out, if you notice over the last month, GDX has made lower lows and lower highs. So I got circled in red there. You can see that. And but the up-down volume, second window down, is pretty much matched its low. It didn't really break a new low. But also on this rally, we have broke to new highs where GDX has not yet broke to new highs above the previous high. So this is a positive divergence both on a previous down, or the previous, even though GDX made lower lows, this indicator pretty much just matched its lows. Now we're in a rally mode, and this indicator is already broke above the previous high, and it's actually attacking, if not matching, the previous high back in mid-July. So what that tells me, GDX at a minimum should get back to its previous highs, if not keep going. We'll have to wait and see how this works out. But I did previous examples. If you go back to December of 2023, the top window is the GDX. If you notice the next window down, GDX made higher highs. This indicator made lower highs, showing up-down volume was weakening. And back in June of this year, GDX was kind of consolidating down, and both those indicators were actually just going sideways, showing there was strength in the market. So this current rally, even though you have some consolidations, the bigger trend remains bullish. And on a short-term basis, we should probably break above the high we had in July. Excuse me. So that's something I'm watching for. So let's go to chart 5.
Absolutely. All right, I have chart 5 up. Yep.
Yeah, this is another indicator. This is the, I think it's the daily chart. Anyhow, the middle window is a silver-gold ratio, and I use the ETFs instead of the silver-gold period because you have to wait on a close to get that. But anyhow, but SLV and GLD, they're currently updated all the time. And usually when this ratio gets really plummeted, I guess you might say, the RSI will fall down below around 30. And I marked all the times. I used 12, and 12 didn't work out as good, so I switched it back to 18, did a back study on it, and the 18 period RSI seems to work really well. So every time the RSI gets down below 30 on an 18 RSI, you're usually at a minimum of a short-term low. And actually yesterday the RSI hit below 30, even though the market's up a little bit. It hit it twice, once on August 5th and yesterday again. So this also adds, bullish situations because sometimes they can pick out significant lows, which it did back in the COVID crash. It picked out that low, then that low before it, and it looks like about May of 2019 it picked out that low. And so anyhow, it's picking out lows. So this is another bullish short-term picture here.
Fantastic. Yeah, Tim, stay right there. Folks, we'll be right back with Tim Ord of the Ord Oracle in just a moment.
If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors. For traders who crave risk, Direxion's daily leveraged and inverse ETFs provide opportunities to magnify short-term perspectives with up to 3 times a daily leverage, utilize bull and bear funds from both sides of the trade, and trade through rapidly changing markets. These are highly leveraged ETFs with daily resetting designed for short-term trading, not long-term investing. Whether you're a bull or a bear, you choose the Direxion. For up-to-date pricing and performance, go to Direxion.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direxion.com. Read carefully. Distributor Foreside Fund Services, LLC.
The reality is that navigating financial markets can be risky. Markets can be chaotic and difficult to understand. Having the latest market advice can help you turn this chaos into a key for creating winning trades. At TFNN, we understand that it can be hard to find reliable market news. That's why each of our market experts offers their very own market newsletter. a must-have tool for every trader out there striving to find an edge in today's markets. TFNN newsletters cover every aspect of the markets so you can analyze the market before you trade. Try any of our great newsletters risk-free with our 30-day money-back guarantee. Just visit the Newsletters tab on the front page of TFNN.com. TFNN, educating investors.
TFNN has launched the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Tom O'Brien.
Welcome back, everyone. This is Jacob Shoup filling in for Tom O'Brien. We are joined by Tim Ord of the Ord Oracle. He's on every Tuesday and Thursday for the Tom O'Brien Show. Before we get back to Tim, I want to show you guys over here at TFNN.com. You can go over to the Services tab. And we have two fantastic webinars from Tim Ord. That is the Secret Science of Market Tops with Tim Ord and 6 Secret Ratios Every Trader Should Know. He's been in the market for quite a long time. And if you are really trying to dig in to understand what he's saying and just kind of expand your arsenal regarding trading, I would strongly recommend checking these out. They're really fantastic. All right, so Tim, before we went to the break, we were talking about the silver over the gold there. Talking about the RSI, I didn't know if you had any other thoughts you wanted to clear up on that before we moved on into the SPX.
No, it seems like we're due for a kind of a breakout of the sideways consolidation, probably get a rally going here. And, the monthlies, the weeklies, and the weeklies are on a buy signal. The dailies are flipping bullish. Actually, they flipped bullish on August 5th. And this is another one kind of with the RSI getting down there below 30 twice on the gold-silver ratio. It's probably going to start another impulse wave here. So it looks bullish for the gold stocks, I guess you might say. So that's that. So let's go to chart 6.
Perfect.
We're gonna flip to the equity market.
Yep.
And this is I've kind of been bullish all year. And even though we may see a trading range here develop, but this is kind of a good indicator to determine if you're in a bull or bear market. This indicator only gets triggered in bull markets. So once this is triggered, the bull market or the new highs are still coming. And this indicator is called the Zwag Breath Thrust Indicator. And I call it ZBT for short because Zwag Breath Thrust Indicator is a mouthful. But anyhow, I got some red lines and blue lines on this chart, and that's when this indicator has been triggered. And to trigger this indicator, it's what it does. It's advancing issues over total issues, and you take that 10-day average, and when it gets below, to start the indicator, to trigger the indicator, there's two parts to it. It needs to get to 0.4 or lower. Or on August 5th, we hit 0.4. So, okay, it's triggered. Will it actually complete its trigger? And to do that, it has to go to 0.6 in 10 business days, which is August 19th, this coming Monday. And so when I did this chart today, it's 0.59. So we're just a breath away of 0.59. And still, this is updated on today's close. So it'd be today's close, tomorrow's close, and Monday's close. So if the market holds steady, if not move higher, over the next 3 days, chances are this indicator will get triggered. And that's not necessarily picks the exact bottom. It tells you the future of a bull market. Sometimes it comes exactly bottom. Sometimes it builds a base. But the worst case scenario, it builds a base. It really, the downtrend we had going to August 5th, in other words, is over. The worst case scenario now, if this indicator triggers, is just a test of the August 5th low. That would be the worst case scenario. The best case scenario is for this rally just to continue, which is common. If you notice the last two times, it did just that. It got to 0.5 and went up, or 0.4, went up to 0.6, and the market just kept on chugging. I don't think we're going to do it this time. I think we're going to hit 0.6. Could do it tonight's close. We'll have to wait and see. But if not, it's probably a good chance we'll do it tomorrow because the market's got quite a bit of momentum here. But if it does trigger, which I think it will, that suggests we haven't seen the final highs in this market. So that's what this indicator is good for. So this indicator only gets triggered, again, in bull markets. It doesn't show up in bear markets. So anyhow, so chances are, there's nothing being bearish here in the market. This rally is getting kind of fast. So let's kind of look at where it may go.
Yeah. I have chart 7 up right now.
Yeah. Okay, this is a short-term view. On your show, I thought we'd find support in that green I shaded, the kind of a light green area going back to mid-May there. Because we had a lot of panic in that region according to the trend close. I thought we may bottom in that area. Well, the market did shoot through that area a little bit on August 5th. It hit right below it, then went right back into it. But that's a big support area. And I did list the trend closes, recent trend closes on this decline. I haven't really listed on the advance yet. But I thought we may get back to, today's price is up against or close to it, the high of around 555, which is basically the August 1st or end of July there, that high. Either the market's going to stop there, pull back a little bit. If not, we may just push through that high and go up to the gap off the July high, which is around 560. So we're not too far away from price, some sort of a high here. If you look at the bottom window, I kind of use this. If this indicator just keeps going up, then and hitting new highs along with the S&Ps, that's usually the market will continue higher. So we had over the last couple of days, even today so far, this indicator is hitting higher highs as well as the S&Ps. That tells me probably the market's going to keep going higher. Normally you'll get a divergence where the S&Ps hit a higher high and the SPX ratio will make a lower high. We had one here basically, looks like about the 12th of August there. We kind of hesitated there, and so I was kind of watching if we were going to make a higher high. It turns out the next day we did. We kept going. And so far it remains bullish. So probably we're at least going to touch the late July, early August high and find a little bit of resistance, and we may push through that and get up to 560. But it also, as of today, as we 1, 2, 3, 4, 5, today marks 6 days up in a row.
Yeah,
6 days up in a row. Predict the market will be higher 83% of the time within 5 days or 5 days. Matter of fact, it's starting to take 6 days now, but it's around 5 days. So we haven't seen, even though we may see resistance at the July up around 555 on the SPY, I don't think it'll be the final high, because we may consolidate a little bit and probably, if not next week, the week after, we may blow through and get up to the gap high. So there's lots of stuff to watch how momentum works. But since up 6 days, you don't really want to bet against that being a top of any consequence, because 83% of the time, the market will see a higher high. So momentum's up.
Interesting.
VIX is making lower lows, and the market's making higher highs. So let momentum run out, and don't guess where the next high will be. The market will tell you. The VIX will show up or something.
Right.
And there'll be some other indicators that'll tell you, yeah, you're probably running out of steam to the upside. So far, that has not happened.
Awesome. Well, Tim, thank you so much. That was very insightful. We love having you on here. I hope you take care. We'll see you next Tuesday, okay?
All right. Sounds good.
All right, folks. That was just Tim Moore to the Oracle. We'll be right back for a short break.
The stock market is a delicate interconnecting web of commodities, equities, and trader psychology. When one string of the web is pulled, it has a ripple effect across the broader market. This is where opportunity lies. But how are you to gather all of this information into one cohesive model when you're already spending your energy looking for any possible trade opportunities? Luckily, you don't have to worry about that, as Tom O'Brien has brought all important market news to you in one single newsletter, Market Insights. Market Insights provides a daily overview of what's happening in the indexes, bonds, gold, and more. Follow along with Tom daily as he analyzes the components that affect the overall movement of the stock market, giving insight into how each one plays either a bullish or bearish role. Tom also analyzes specific equities that he believes has the potential to make huge returns, and his track record proves his analysis right. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Don't let the market leave you in the dust.
In the world of trading, only a few names stand out like Larry Pesavento, a pro's pro with over 50 years of experience. Larry has seen it all. A former Chicago Mercantile Exchange member, Larry has authored 10 books and trained over 1,000 traders with his unmatched expertise. Introducing Fibonacci 24/7, Larry Pesavento's daily trading service that turns the complexity of markets into opportunities. Published every Sunday, receive a comprehensive report packed with detailed commentary, charts, and videos that illuminate the patterns shaping the markets, with updates throughout the week exclusively for subscribers. Whether through charts or videos, Larry's analysis is your roadmap to navigating the markets. You can sign up now at TFNN.com for just $97. And with all TFNN newsletters backed by a 30-day money-back guarantee, you have nothing to risk. For all the details, visit TFNN.com. You'll find Fibonacci 24/7 right under the newsletters tab.
The reality is that navigating financial markets can be risky. Markets can be chaotic and difficult to understand. Having the latest market advice can help you turn this chaos into a key for creating winning trades. At TFNN, we understand that it can be hard to find reliable market news. That's why each of our market experts offers their very own market newsletter. A must-have tool for every trader out there striving to find an edge in today's markets. TFNN newsletters cover every aspect of the markets so you can analyze the market before you trade. Try any of our great newsletters risk-free with our 30-day money-back guarantee. Just visit the Newsletters tab on the front page of TFNN.com. TFNN. Educating investors.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Welcome back, everyone. This is Jacob Shoup filling in for Tom O'Brien. We were just joined by Tim Ord of Ord Oracle. If you missed the interview or want to go back over it in your free time, you can go to YouTube and type in Tiger Financial News Network or just TFNN. And shortly after the end of broadcasting today, you should see the archive up there. Make sure to give that video a like and give us a subscribe. It helps us out immensely. Looking at the SPY, up about 1.52% right now. So you're going to look at a longer picture. I mean, we're gunning right there for the highs of 565 right here. Trading at 552 currently. You're having some volume on the daily. A little bit to the downside, but we just had such a strong run up today. That's unlikely we're going to reach the lows of the day. Russell up about 2.42% currently. NQs as well up about 2.45. The Dow Jones trading up 1.3%. Look at that. Gold, silver really doing quite well today, up 3.7%. Still around that 28 level. We'll see if we can move and get up above that 30. Here's some of its highs for the year. And then copper up about 4.14, and crude oil still chugging along. I had an email about the inverted yield curve. And since we only have a short segment, I mean, I guess to talk about it. I think the individual was suggesting, you know, before recessions, right, you have an inversion of the yield curve. What I think is going on there is like a lot of these indicators that we've had in the past, I think probably don't work so well right now. I think the market's been funky for a very long time. with quantitative easing. I mean, you had just cheap money for a long. I speak about that all the time, right? I think what's happening is, these like 3 months, even the 2 years, right, are just getting like front loaded so hard with Fed rates. And then once the Feds begin to cut rates, I think you're going to see that inversion kind of recover. So I don't think that this is indicative of a recession. We've been in an inverted yield curve for like 2 years or something like that. And you have seen some broadening between the 3-month and the 10-year. But I don't think that means that we're in the recession. I think there's a lot of different stuff going on. Now, if you had low interest rates in an inverted yield curve, maybe that might be a little weird. Anyways, folks, thank you so much for joining me today. I'll be back with you tomorrow. We have Tommy O'Brien on at 9 a.m. for the morning market kickoff. See you then.
Building wealth trading in the stock